Good morning, good afternoon, good evening, wherever this finds you. Welcome to the 69th Emerging Growth Conference and day 2 of our 2-day Super Virtual Investor Conference. I'm Anna Berry. A few notes. Today we're running until about 5 p.m. Eastern. Now, when we switch to the next company, you might see a black screen for a moment. That's just us moving over to the next presenter. But if you experience downtime, refresh your browser. Everything usually works properly once you do that. And our platform does work best on Google Chrome. So if you're watching from an Apple device, you have to hit the play button to start the session. All of our conferences are uploaded to our YouTube channel. So please subscribe, youtube.com/Emerging Growth Conference. Now, today, during each company's presentation, you can submit questions through our webcast module, and we will attempt to address as many of these at the end of the presentation. One last note, after today's event, you'll be redirected to the registration page for our next conference. So stay on or come back to reserve your spot early. Let's jump right in with Strawberry Fields REIT Inc. Trades on the New York Stock Exchange under the symbol STRW and is a self-administered real estate investment trust engaged in the ownership, acquisition, development, and leasing of skilled nursing and certain other healthcare-related properties. Happy to welcome Chairman and CEO Moishe Gubin. Nice to see you again. Good morning.
Thank you. I'm happy to be here. Good to see you as well. I'll jump right in.
Yeah, jump right in. Tell us about Strawberry Fields.
All right. Well, we came in front of you guys about 2 months ago, and this is and we told you about our company. But for those who are joining and new to these conferences, we're a company we're a healthcare REIT listed on the New York Stock Exchange, like Anna said, stock symbol STRW. Our company has been in business through different iterations over 20 years. My partner Michael Blisco and myself, we started off as we actually worked at the original nursing homes, and we started compiling a portfolio together. In 2015, we took the company and we spun it off to be its own propco, and Michael became the CEO of the opco, and we started buying and diversifying away from related party transactions. At that point, we had 33 facilities, and since then we've grown to be 109 facilities in 9 states. I am like she said, I'm the CEO, I'm the chairman, I'm the founder of the company with Michael. He was the founder with me, and unlike a lot of the other REITs, I've been here since day one, and I bought every asset. I've been there for every deal. I've made every single deal, and our portfolio is nice and stable and strong. Currently, our dividend yield is 6.1%. Our AFFO from 2023 was almost $53 million, and that's $1.02 a share. We expect the 2024 forecasted AFFO to be $1.14 a share. In 2023, our EBITDA was close to $80 million, and we expect the forecasted EBITDA per share to be $1.74 in 2024. Our debt is lower than 6 times. We're at 5.5 times, and most of our debt sits with HUD debt, with averages like about 25-year maturity at this point. All straight line debt with a weighted average of about 388. As I go through the slides, feel free to ask questions for Anna to ask me. We'll go on to the next slide here. Most of our out of our total portfolio, we lease to related parties about 60%. Everything else is outside. Like I said, we've continued to diversify, and our strategy going forward is to be leasing to outside people. Out of the 109 licenses, those are 97 properties, of which 99 are nursing homes, 2 of them are hospitals, and 8 of them are assisted livings, which right around 12,500 licensed beds. Our leases, how we do our leases, are normally 10-year leases with 2 5-year renewals, with generally 3% annual increases, and usually we ask for guarantees of the total lease. We like to do the master lease concept, which, if you're not familiar with it, is just basically taking, instead of individual properties, because all the nursing homes have individual licenses and they're their own operating entities. But for our comfortability, we like to turn them into portfolio master leases, so that if a property is going bad, the tenant can't just walk away from property. That they have a reason to stick around because the total portfolio, the total master lease is doing well. Our properties are in 9 states, which include Arkansas, Illinois, Indiana, Michigan, Kentucky, Oklahoma, Tennessee, Ohio, and Texas. And like we said before, most of our assets are in skilled nursing facilities, and we do have a couple of LTACs and 8 ALFs. As of 12/31/2023, we have a really strong pipeline, lots of deals to get done. Happily, we're still listed on the Israeli stock market as well for debt, and pricing is nice, inexpensive today, where a lot of our deals are able to be financed through there. Today, going forward, is about 6 to 7% interest on 3-year with a balloon at the end. Like we mentioned earlier, 2023 AFFO was right around $53 million, and we have a good coverage on our rent coverage of over 1.5 times. In 2023, we collected 100% of our rents, which we're very proud of. I know a lot of other places are having trouble. In our world, we have single tenant, triple net lease properties. And so we get 1 rent check per building, and typically we're collecting all of our rents on the first of the month. Our timeline and how we grew, you could see how we started with in 2015 with 33 facilities, and in 8 years got up to 109. Balance sheet wise, we started with like 300 million, and today asset wise we're probably close to $1.1 billion. But you could see from our timeline, the bigger growth was 16, and then 19. Our model has us buying a certain way, and if the deal doesn't make sense, we just don't do the deal. So we've continued to do things exactly the same way. People ask, cap rates changing this or that. Our math stays the same. We buy at a 10 cap, and all the different metrics that we need to have for the deal to work. We haven't changed our policy in over 15 years. It's worked real well, and our business is running real strong. I don't feel we need to change anything. But as you see, we some years it's anemic and we don't have any deals, and other years there's a bunch of deals and we close a bunch of deals. And we haven't had a deal where we haven't been able to find the money to be able to close a deal. And again, every single deal we do is accretive to shareholder value, which is our number one goal, is to bring returns to our shareholders. And by doing so, I'll go through the criteria in a minute of what we're looking for in tenants. But for the meantime, this is our map of what our facilities are around the country. As you could tell, we take an approach of if I was the operator, what would I want to do? And a lot of that has to do with efficiency and how to manage things. And so if you look at the map, you see we're basically every location where we are, we have, bulk, or we have mass in those locations, and we haven't bought any one-offs anywhere in the country. I haven't, gone to Wyoming to buy a building there. We stick to where we are. We try to grow the master leases, or we like to buy a big enough portfolio to put in a master lease on day one. And as you could see, this is what our map looks like. And again, this is 8. Really the yellow. I'm colorblind, so I hope that's yellow. So 8 are, or 7 are our main lessees, or master lessees, and then the yellow are others. A little bit about us. So like I said, I'm chairman, CEO, I'm founder. Really, I should say co-founder. My partner Michael was there day one, but been there from the beginning. My background is I'm a CPA. I started the nursing home business in 1997 as an accounts payable payroll bookkeeper. Grew up as a poor kid in Queens, and graduated college in May of '98 from Turo, and with an accounting degree. And I started working in the nursing homes my last semester, and luckily, or opportunity knocked, and worked my way through one company, and then moved to the Midwest. Came to work for another company, which is where I met Michael. And Michael, previous to that, had started as a CNA in the nursing homes, and he worked his way through to become a licensed administrator. And we met working for a friend of ours who has a nursing home company, or had a nursing home company. Now it's changed to a different name, in the Midwest. And we started working together. And after we realized right away when we started working together how well we do together, me as a strategist and my partner as an executioner, we started buying. We left that company about 2 years later, which is October 31st, 2003. And that's when we bought our first facility together. So that's myself, that's my partner, Michael. Our management team is me at the top. We have Jeff Beitner, who's a chief investment officer. He's been with us already now for a couple of years. And he does investor relations. We most recently brought in a new CFO in January. So he's just finishing his first quarter, working on the first quarter financials. Previously had been a CFO for some other publicly traded companies' divisions that they had. And then lastly, David Gross is our general counsel. He's been with us for probably 13, 14 years, papered up, hundreds of deals at this point. As far as the board of directors go, I'm the chairman. We have Essel Bailey, who's a director. Essel Bailey is known to anybody in the healthcare world. He's the one who started Omega, which is OHI. They are who we try to emulate. They are the big gorilla, and God willing, we will surpass them. Might take me a bunch of time, but God willing, we'll get there. We talked about Michael. Then we got Reed Shapiro and Jack Levine, both of them bringing strengths to our board. We have a really good board, gets along really good with management, which is why we're running really, really well. Our underwriting and investment criteria, like I said, hasn't changed in many, many years. The key points to be made are that, we're looking for, with a 10 cap purchase, with leverage that basically gives us a 20% levered return over 10-year investment horizon. It gives us a 12% ROE at 50% LTV at an 8% interest rate. Simple math. That being said, we look at things, like I said earlier, we look at things as an operator would, and everything is really just common sense. How would we want to operate? Does it make sense, geographically? Does it make sense, how that building needs to run? And so typically before we do a deal, our tenant will tell us how they expect that they're going to run. And then we kind of put that together as a mesh it against how I think it would run if we were running it. And then if that kind of works, then we do our deal. So once we do that deal, full due diligence, obviously, and then really our biggest thing that we do afterwards is manage the asset by making sure that our tenants are taking good care of the residents. We ask questions. I mean, we don't have any real ability to go in there and tell them how to operate. They operate exclusively. They have the right to be there. They pay for that in the lease. But we can give them our points of view and give them our observations that we see when we tour the building twice a year, and/or if we analyze their financial results. And to the tenants that actually want to have that sounding board, I believe they get a benefit out of it. To the ones that don't want to take us up on that, that's okay too. Recent acquisitions, we closed on a bunch of facilities in 21 for $81 million in Tennessee and Kentucky. And in 2023, we bought a facility in Kentucky, and we got a bunch of deals going forward. And our biggest deal will be the August deal that we did for $102 million in Indiana, which I believe will go down as being one of our best deals that we've made. Our consulting groups that operate our facilities that we lease to are listed here. Infinity, Landmark, Oasis. These are all seasoned operators coming from a good background, having every one of them vetted by us, and we have the ultimate trust and faith that they're going to do a good job taking care of the residents, and that they'll be successful financially for them to be able to pay us the rent, which that's how our world goes round. We find deals that work. We find tenants that'll be good tenants, that we feel that'll be good tenants. We strike a deal where we feel that they could succeed with a good rent coverage on day one. And then we're off to the races. They pay us rent. And then we take that aggregated balance sheet and, we manage the balance sheet appropriately with debt and, how to borrow, where to borrow from, who to have relationships with, staying away from lenders that charge me exorbitant fees or, charge me good faith deposits and stuff that I don't like. But other than that, we're loyal to our people and they're loyal to us, and loyal to our tenants as well. I mean, if a tenant finds a deal in a state where they're operating, we'll back them, buy it, lease it to them, same exact math, throw it into the master lease, and continue to go that way. And that's been a success for us. The actual industry itself, everybody believes, everyone I talk to believes that it should be a strong business going forward. High barriers of entry. We know about the aging population in America. There's a strong demand, and at the same token, there's been, it costs too much money to build new nursing homes, and at the same token, the regulatory environment, which goes from friendly to not friendly, every administration or, it's cyclical. Right now it's not friendly, really not friendly. And with that, nursing homes get closed down. And with that, that diminishes supply, whereas demand continues to grow. It doesn't take an economics major to understand that when you have a high demand and low supply, values go up. And at the end of the day, the nursing home operators need to make a profit for the business to work. And Congress passed a law in the 70s for the way the reimbursement works. And so as long as nothing's, things are done in clean manner, buildings should all do well. So that's the industry. The population is growing, as we know, and the aging. The age, if you look from this graph, over 85 number is going to be, huge. And those are not all, but a majority of those will end up in nursing homes. And because nursing homes are the cheapest way to take care of somebody at the end of the day. Hospitals are the most expensive, or LTACs, and the SNFs are the least expensive. This is the growth rate of population in SNFs. Due to the increase in life expectancy in the United States, we expect it to it should be really good, and it's good tailwinds for our business. Our financial highlights, this to me, and I really believe at the end of the day that this net income and this growth, what we're doing, this is all being done while I believe our tenants are providing good care to the residents. And being done the right way. When we vet, to go back to a point, when we vet our tenants, we're not looking for, we're looking for, the people, who they are as human beings, almost as important as their ability for their financial health, for them to be able to run a business. And we like to think that the people that we're associated with today are good people and also good operators. That being said, if you look at our EBITDA growth, over 10%, from $49 million in 18 to almost 80 million in 23. Our AFFO growth, almost 20%, from 22 million in 18 to 53 million in 23. 24 is going to be killer, God willing. The growth rate for assets speaks for itself, and the rents as well. Those kind of go together. We feel our investment in our company, again, under the stock symbol of STRW on the New York Stock Exchange, we feel it's a great investment. Mainly, if you look from the symbol, from the math, we're returning today over a 6% dividend yield. And out of that 6% dividend yield, that's only a 44% payout ratio, which means we're really making, close to a 14, 15% return, maybe 16% return. And we're using that other money, which is tax-free. We're using that cash to go buy more deals, which is accretive to like I said earlier, the AFFO per share. And so with that being said, we feel, and I don't know if we don't have a slide here, but maybe we should include it. The marketplace for REITs today, are anywhere between a 10 and 15 multiple of AFFO, of FFO. And on top of that, the healthcare is like a 13.4% multiple off of FFO. And we feel that our stock is way undervalued, even though we did hit a 52-week high yesterday at $8 a share. Proud of that, but it's not enough. We gotta get to a much larger. We got to get past 10, 11, 12 a share, God willing. Debt structure, we have the benefit of being able to borrow HUD money, money backed by HUD. And that's been part of our strategy since the day I bought the first nursing home. And today we're sitting with $270 million about of HUD debt at 388, which is straight line AM, which is really good for business as far as cash flow. We have secured bank debt at 165 million. That's at SOFR plus 350. Like I said earlier, the bond debt is way cheaper. And so we're going to maybe be using the bond arena for current and future acquisitions. As it is, we have a bunch of properties with no debt on them, which is something that's usually lost in a lot of these conversations of how strong our balance sheet is. Our debt sits on, less than, 90% of our assets, probably closer to maybe 80% of our assets have debt on them. And we continue to put debt where debt makes sense to be put, and everything else we leave debt free. And HUD debt has no cross collateralization or cross default provisions. So if something were to go bad, God forbid, we'd be able to extricate one asset out of that borrowing and not affect the rest of the portfolio. So that's why that's one of the reasons that HUD is so attractive. HUD money. Besides the point that you can also modify rates mid-term of that debt without having a prepayment penalty. So when the rates go down, like even now, we're going to take a deal at 6%. Or it's basically a 10-year Treasury plus 175 or plus 2. And so you take money today at 6-7%. When the rates go back down in the next few years, we should be able to modify the rate down. That being said, we have almost $61 million in bond debt at 5.7 as an interest rate, and we got unsecured $42 million of bond debt at 9%. We don't have a slide here, but our maturities are about 3 years away. Actually, all that debt is all listed to almost all mature around the same time, and we expect to be able to refinance. We should be able to refinance at whatever market rates are at that point for those things, other than whatever is going to go into HUD. This last slide, I think it's the second to last slide, is about our census as of December. Our occupancy is at 66% today in our portfolio. Now, we're different than a lot of the other folks. We're presenting data based on the licensed beds and not necessarily on how many beds are set up. A lot of the nursing homes that were built in the 70s, at the time, they hadn't built them for thinking about storage and therapy. Those were concepts that didn't exist in those days. That didn't happen at the nursing homes. So years later, there's a lot of rooms, and anybody in the nursing home business will tell you there's plenty of rooms in nursing homes that can never ever be used as nursing beds. They're part of the license. So if you ever want to build onto the nursing home, you have those beds that you can do. But reality is those beds are never going to be used. So we use in our numbers, and our real occupancy is probably mid 70s. For example, we have a building Midway in Illinois, which is full. They don't have a bed. They maybe have 1 or 2 beds available, but that's 40 beds less than their license. So they're showing at 90% occupancy when they really should be 100% occupancy. Just as a random example. But nevertheless, our average size of facility is 122 beds. We don't like buying smaller facilities. We feel that we need a 90-bed facility or more, with the average of about 82 residents in the building. As you can see, this is typical. Medicaid is a little bit below 80% as the payer source. And then Medicare and insurance is about 15%, which is pretty good. Typically in the country, it's about 10%. And our private is about 7%, which is a little bit lower than what typically is. If you look at our base rent by consultants, again, we use the term consultant because that's what they are to their facilities. The facilities themselves are individually licensed, and there's no management companies really anymore in the country. I mean, there's probably still some that still exist from before, but in the last 10 years, 15 years, there's no real management companies like the way it used to be, where you consolidate your financial statements into one financial statement, and then that management company has control over the say of the operations. That's gone away over the last 10, maybe more than that. There's still people do stuff, because people don't like changing, but in reality, there's very few. There's whatever is left is left. There's no one doing that today as a new thing. Indiana now is our largest part of our portfolio. Used to be Illinois. We tried getting that pie of Illinois to be lowered, and now it's at 20%. We'd like to still continue to grow. And base rate by state, as you can see, Indiana is the largest today. Illinois is 24% as base rent. And that's our presentation. I don't know if there's any questions out there.
We do have questions. Yeah,
so
I know we have a little bit of time. You were on a roll, so I let you keep going. But let's talk. Margaret asks, wants you to clarify. Did you say 6% in dividend, and what percent of your taxable income is that?
So yeah, our dividend yield today is between 6 and like 6.25, and yeah, we're distributing 95% of our net income. Keep in mind, we're real estate, so we have $35 million or so, or $32 million of depreciation. So that's free cash flow per share, but it eats away at the net income, which is good for us because then we have that cash that we could go use and buy more assets with.
And Mark Franco asks, are you locked into healthcare, or can you take other opportunities if one presents itself?
Well, years ago, that's a good question. I mean, reality is we're not locked into anything, but reality is that, well, for years and years and years, we were pushed that, the marketplace wants us to be industry specific. And the REITs that have multiple, divisions of, different kind of, mixing industrial together with medical, the marketplace doesn't like that because it's not easy enough for them to analyze. And then when the economy changes, right? So like we're somewhat inflation proof, right? Because our business is, it's not based on market rents, right? The top line revenue number comes from what the government decides they're going to pay you. And it's not something that's an arbitrary decision. When someone needs to go to a nursing home, they go to a nursing home. Somebody doesn't sit there and say, the nursing home might be too expensive, so we're going to keep mom at home, but they don't do that. You do that maybe for assisted living. You do that for multifamily. You certainly do that for the economics of office space and retail and stuff like that. But, if the economy goes bad, people still have to go to a nursing home when they need to go to a nursing home. And so from that point of view, we wanted to keep being a pure play mainly SNF healthcare REIT, because I think in the long run, when the investors buy into our stock and our company, we should have a way better following and a way better stable knowledgeable investor base, and which is good for the stock in the long run.
Makes sense. Dante Castaneda says, very interesting story. He has a question. What's the benefit to structure as a REIT versus a publicly traded corporation? Can you explain the benefit to an investor?
Yeah, I mean, the easiest way to understand that is, a regular C Corp has double taxation. The company pays tax, and then when you get your dividends, you're paying tax. The benefit of the REIT basically moves the onus of the tax onto the individual. So it's only singular tax, and it gets taxed at your current tax rate. So depending on where you are, like this is a perfect investment for someone who's older and needs fixed income. We're a stable of an investment you can find that dividend dollar amount, not the rate, but the dividend dollar amount is only going to continue to go up. Okay. And because our rents go up 3% a year. right? So where there's more cash flow and there's more, and so where I'm going with this is that, so that person who's, let's say, a retiree, they're taxed at their retiree. If they don't have other income and they're on a fixed income kind of deal, they're taxed at their rate versus, the corporate tax rate that you would have been taxed at, which is a lot higher. So it's from a organizational structure, they're exactly the same, but from a tax perspective, it's better for the investor to be in a REIT structure so that they're taxed at their personal tax rate versus the corporate tax rate, and it's only singular tax versus the double taxation.
Okay. Chad Gomez asks, is any of your debt with variable rates? And if so, what is that doing to your income?
Yeah, so we have one loan, which is really two loans, but it's one lender that's variable rate. That's at SOFR plus 3.5. That's on this right here, $165 million. At this point, there's only positive to be said, because I don't think there's anybody on this earth, or maybe there's somebody, but there's very, very few people that feel that interest rates are going to go further up. I think most people are thinking that it's lay low, it's going to stay the same, or it's going to go down. And so from that perspective, right, for every 1% of interest that goes down, that's 1% less interest on $165 million, which from my math was at 1.65 million of net income, because you'll have less interest expense. So that's how we don't have any exposure. I mean, it's exposure, but because we're at the top, at least most people believe we're at the top, then we have an upside in that deal if interest rates go down.
And last question, just due to time, Jared Moran asks, can you talk about past and future issuances of shares, if you have any?
That's an interesting question. So we have not really done anything. We didn't do a public offering. When we went public as a soft opening from our current shareholders, which were a lot of those were employees and people from Michael and Moishe world that we wanted to thank for their help of getting us to where we are in life. And so we gifted a bunch of people stock, and then everything else was word of mouth, and people started buying the stock, and a few people sold a little bit of stock, and so we're now finally working the public market, where we're going to issue stock only from the point of view just so we could get more shareholders into the mix, get more shares out there, get a little bit more liquidity to the stock. We don't really need the cash because we haven't had a deal that we haven't been able to do. Because we didn't have the cash for it, but we're going to do it just to kind of get people into the mix. That should be exciting for in 2024, because we're going to do a couple different things. At some point, we got to do an ATM, and so we could kind of be like all the other REITs that are public. But yeah, that was a good question. We have a whole lot to do. Only from the point of view as we're sky's the limit of where we could take this company with doing deals exactly the same way we've always done deals. And when we need capital to support our balance sheet, we'll I want to be able to get that capital. And with that, we have to do issuances earlier so that we can have that, accessibility.
Well, Moishe, thank you so much. We do have more questions for you, but we're out of time. We'll send them to you so you can answer on your own. But I know you'll be back with some more updates, and great presentation today. Thank you.
Thank you so much. Have a great day.
Thank you too. All right, stay with us. We'll be right back with Citizens.